Every one of your companies, and I talked about this a moment ago, should have a board of advisors if it's an LLC, or a board of directors if it's a corporation. Now, some of you are like, well, yeah, it's a pain to have a board meeting. My accountant or lawyer tells me to do it all the time. Yes, we do, because it's a great write-off. The perfect time for a board meeting is on a Thursday in November after a turkey dinner.
If you are listening and not watching this episode, you may not see our guest, who is an annual guest in Lab Coat Agents. And I just realized today it's the first time we've had him on the podcast. So welcome to the podcast, Mark Kohler. And before I turn it over to you, because we've got tons of year-end tax tips, as I was just talking to him off air, and I said, usually we have him on right before the tax deadline. We have him on in February, March. But you know what? We're going to get ahead of it this year. We're going to make some predictions for what he expects might happen as it relates to taxes and the Trump presidency. But Mark, I'm actually going to throw you for a loop here for a second, because, you know, I was looking at your website and you talk about how you're changing the tax industry, right? You're that's it. You're changing the tax industry. And one of the things that I find most fascinating about you is that you are definitely not our grandfather's CPA. And I mean, and you're looking at your one sheeter, you know, the first thing it says at the top, besides being a top 0.5% podcast that you have on your own, you're an influencer, man. You've got hundreds of thousands, millions of followers, views, the whole thing. Dude, that's totally turning this industry on its head, which I personally find fascinating. I'm going to have you just do kind of a quick intro of yourself. Many of our audience knows you, so I want to get to brass tacks, but give it to us real quick and kind of let us know what's been new in your world.
Jeff, thanks so much. Thanks for having me. It's an honor. Love your tribe, your community. It's always a pleasure to be here. Yeah, I'm not your grandfather's CPA. I'm your girlfriend's CPA. And last night I was telling her about the year-end tax tips. I don't know if she'll pass that along to you, but
well played. Well played.
No, I just want to have fun when I'm saving money. And, you know, it's easier to save money than make money. But the number one cost in our lives, taxes, and no one wants to talk about it because it's boring or complicated. No more. I make it fun, and I make it easy to understand, and I make it actionable, street smart, sexy, Main Street strategies. And it's super powerful, and excited to talk today. So I'm CPA, attorney, author, podcaster, YouTube videos. We've got a great law firm and our trust company helping people self-direct their IRAs and 401ks. And the biggest mission of mine now, and it's really culminating, is to be my life's work in this 25th year. I know I look like I'm in my 30s, but 25 years in the industry, is I'm now training other CPAs, enrolled agents, accountants with a certification program where I take all the strategies I've ever learned and combine it with our tribe and community and everything they've learned. And this certification is changing the industry. So many accountants are leaving because they're burned out. Enrollment's down in college, universities, and accounting programs. And it's sad. It's on fire. And I'm running into the building. I want to help accounting be great again. And then we're going to do it, man. It's going to be good.
No pun intended there.
No way.
I love it, man. I love it. And let me ask you this. If I had asked you, if I had interviewed you, let's just say probably about 10 or 15 years ago, would you have been able to manifest or predict that you would be doing the things that you're doing today, which is probably less, you know, punching a calculator and more talking to a camera?
It was my dream, and I was talking about it. 10 years ago, I was saying I want to be number one in the country in tax and legal, helping small business owners. And now I can confidently say I am. And I say that with complete humility and gratitude. And I'm so fortunate to be where I'm at now. But I wanted to be. I was on YouTube 15 years ago with my teenage son and a camera, you know, in the garage, you know, hey man, listen to my tax tip. So I was trying and I wanted to be, but it's really a blessing that I'm here now and able to impact so many people because it's tough out there trying to make ends meet, trying to pay the bills, taxes kill us. A lot of what this last election was about was our economy and the tax code, and people are hoping for something good, something big. But you know what? You got to know how to play the game. Don't hate the player, baby. Just learn the game. And I'm here with the rule book.
That's right. Well, let's just dump right in because, again, as I mentioned, we usually talk to you before tax time, not before the end of the year. So this is a slightly different conversation because we are, at the time of this recording, it's the week of Thanksgiving. You've got plenty of time to prepare. So where should we start?
Well, we're going to get back to properly stuffing a turkey and the difference between stuffing and dressing a little later. But until then, here's the thing, Jeff. My team, when you reached out, I was like, yes, yes, because April 14th, that's the punt. I'm golfing on April 15th. There's only a few deductions that are important by April 15th. Get my HSA in, my ESA, maybe an IRA guys, it's December 31st. That's the buzzer. And there's strategies. If you do not move the money or take action in the next 5-6 weeks, it's over. And then April 15th is like, good luck. So this is when real tax lawyers and advisors are the busiest, is right now. We don't even give our tax lawyers or accountants anything off but the main holiday dates. You cannot take your 2 weeks of vacation in November and December. That is our game time. So Jeff, it's legit. It's serious. So I'm glad we're here.
Awesome. Well, where should we start?
Okay, number one is, we'll see how many we get through here, and I'm just let you unpack them. I know you being a business owner and investor, these hit home for you. Cool. Number one is the S Corporation. The S is in small. These are not S Corps in Vegas. They are S Corps. S Corps, we need to take our S Corporation and shelter FICA. We hate FICA. What the FICA? Ugh, FICA sucks. That's Social Security and Medicare. Self-employment tax. So there's 2 points here. One, if you made more than 50 grand a year in your LLC this year, 50 grand of ordinary income. We're not investing, it's small business. There's over 50 million side hustles in America now where you're getting a 1099. People, that's a gateway drug. That's awesome. Freaking give me something to work with. You got a 1099? Awesome. But if you're gonna net over $50,000 in small business income, think 5 grand a month, something like that, we are gonna want to convert you to an S corporation. So you can take your LLC right now in the next 5 weeks and backdate it into an S corporation if you do it right. So it's effective as an S corp for the entire 2024. It's super expensive. We charge $250. I mean, that's what you should be paying your accountant or lawyer to do this, if they know what they're doing. So very easy to do. And remember, people, LLCs do not save taxes. They don't. I've got to make it over to the S corporation. And then step two, for all of you that already have an S corp, and if you make this retroactive S election, you've got to take a reasonable comp. It's a little bit of a salary. I don't care about a paycheck. We're going to do a report in the first week of January called a 941, and you're going to peg your payroll for the year. So if I made 50 grand, I might take 25 grand as W-2 and 25 grand as K-1 pass-through. I just cut my self-employment tax in half, which would have been around $7,500. Now it's $3,200. So I just saved $3,000 making that conversion. Now, you accountants out there, I got to say this, Jeff, real quick. They're freaking out. Oh my gosh, Mark, you got to take more reasonable comp than that and payroll, and you need this. And no. I teach CE courses on reasonable comp. I read every court case on reasonable comp. I've interviewed IRS agents on my podcast for years on reasonable comp. I teach the payroll matrix, and it's a sliding scale of payroll allocation based on your net income. We'll leave it at that, but the point is, people, you need to know what your payroll allocation is. Don't take too much payroll, and we could unpack that a little bit, but that's number one. There's money on the table right there in front of you called FICA.
Let's unpack for a second. So let's just use the example you gave, which was 50 grand. Now, if you take 25 of it as a W-2, there is some tax implication there, right? I mean, not only to you as the receiver of the income, but also as the company. Is that correct?
Yeah, but let's think of it like you were selling something online, you make 50 grand, okay? So you're an LLC, you brought in 75 grand, you spent 25 grand on expenses, cell phone, home office, auto, travel, blah, dining. Okay, you net 50. That's what we're talking about. So 75 gross, 25K in expenses, you net 50 grand. You know, many of you would put that on a Schedule C, as in Charlie, on your 1040. 50 grand. You're gonna get income tax from 50 grand. But you're also going to pay self-employment tax of 15% on that 50,000. That's 7,500 bucks. So when you do the S corp, you're now going to file a corporate return. You're going to take a write-off for paying the number one employee, that's you, 25 grand. And you're going to pay FICA or self-employment tax on that 25 grand, 3,250. So 15% on 25 grand. Okay, cool. Then at the end of the day, you've got your 1040. Now you have 25,000 of profit from your corporation and 25,000 on a W-2. Well, the 25,000 in profit from your corporation does not pay FICA. So we just saved 15% on 25 grand. If you just stayed in LLC, we pay 15% on the whole 50. Now we're gonna split it and pay 15% on 25, not on the other. You still pay income tax on 50. But at the end of the day, we save 3,250. The more money you make, the more you save, baby. So as that income grows, we're going to bring down your payroll as a percentage, find that sweet spot. It's common for our business owners to say 5 grand, 10 grand, 15 grand on FICA. And that's strategy number one.
Got it. Awesome. Correct. Let's go. Number 2.
Well, let's go to the kids. I love this one. Any of you that have kids under age 18 or kids that are 18 or older, how old are your kids, Jeff? I know you have a family.
Kids. They range from almost 6 to 24.
Woo!
Don't ask. Don't ask how that happened.
Oh, I love it. Okay, so this is 2 different strategies. There's a different, it's one strategy, and then 2 different methods for kids under age 18 or over age 18. So let's talk strategy. Millions of Americans pay taxes. Jeff, you and your spouse, your wife, you're gonna pay taxes and then give money to your kids. They're gonna go to the movies. They're gonna buy school clothes, school lunch. They're gonna go to college. They need car payment. They need cell phone payment. We pay taxes at our high bracket and then just give our kids money or pay for their stuff. But when you have a business owner, we wanna say, we wanna ask them the golden question. Isn't your family all about business? A family business? Don't your kids help out in the business? Shred paper? Well, what are some of the things your kids do in your business?
Actually, I put my 6-year-old in videos all the time.
I love it.
All day long, yeah.
I've taken my kids to conferences for years and they're selling books at a table, they're mowing lawns, they're shredding paper, cleaning the office, right? All that. Okay, we need to change our mindset as a business owner and simply start paying our kids above the line. So they can take a paycheck, or just call it a paycheck for now. We'll get through the methodology here in a moment. But give our kids a paycheck, take a write-off in our business. Kids right now, under age 18, that are our children, do not pay taxes on the first 14,000 and change this year.
Under 18.
Under age 18. Well, okay, let's back up. Woo! None of us in this country pay taxes, federal taxes, on our first $14,600. That's our earned income deduction. That's our standard deduction. So if your 12-year-old goes and works out at McDonald's and makes $14,600, they don't pay any taxes on their McDonald's paycheck. If you go out and only make $14,600, you don't pay taxes on that. So all of our kids, when they're under age 18 or over age 18, they don't pay taxes on the first $14,600. So if we pay them $1,000 a month to help in the business, we get a write-off for 12 grand, and they don't even pay federal tax. Done. And so with 2 or 3 kids, we're talking about $10,000, $20,000, $30,000 in write-offs. If the kids are helping in the business, got to be legit. We need to have work duties and responsibilities that are not, cleaning.
How do you prove that?
Good records of just a journal or maybe the calendar or the checklist of what they do, having it handy. And here's the beauty of this. In 25 years, I've never, ever, ever had a client audited where the IRS agent ever even wanted to see what the kids did.
I'm gonna knock on wood. I'm gonna knock on wood for you.
Well, yeah, but here's the thing. This is the American dream. This is small. If the kid that works in the deli in New York City after school, the kid that works on the Oklahoma City farm on the cornfield, the kid in Idaho, potato field, the kid that works for a realtor in San Diego putting stakes in the ground on the weekend for the signs. This family bit. I've had the IRS agents go, oh, what's that? Oh, that's the kids' pay for helping in the business. Done. Who's this? Oh, that's a nurse. Oh, we're going after that. You need to W-2 them. You can't 1099 them. IRS doesn't care. This is in the code. It's normal.
Yeah.
So anyway, you pay your kids, you take a write-off, they don't pay tax.
So you recommend, depending on the income, to max that out to 14.6. But can I ask the question that is, let's just say I'm that business owner. I know I'm going to obviously have just say $100,000 in income, whatever. I'm going to take 14.6 at the beginning of the year, set it aside, knowing that obviously I put my kid to work, but then use that for the expense, like what you mentioned, the gas, the groceries, the school activities. Is that kind of where we go with this? Can I say that? Can I say it that way?
Yes, in concept, you're saying the right things, but there's different ways to go at it. Some of you might, I'll say, I've never seen a client put aside money for the kids' stuff. What we do, the methodology is, all of your kids have to have a debit card. They have to have their own bank account. And I use the same bank for the kids' bank accounts as my business checking. So during the month, during the week, my daughter, that's 21 years old, just before I walked into the studio, was like, hey, I needed some money for this, that, or another. I don't give her money. My corporation sends her money. She gets a 1099 at the end of the year because she's over age 18. We'll talk about that. So I just took a tax write-off for helping her out with gas money, let's say. Yeah. So my kids serve on the board of directors of every one of my companies. They travel with me. They help with business duties, marketing, bird dogging deals, client relationships, client referrals. All of my kids are involved in the business in some way or another. So whenever they ask for money, I don't give it to them. The business does, and we track that. So at the end of the year, December, I find out how much have I transferred to each kid. Kick it out in QuickBooks. I might true it up, pay him a little extra, pay him a little less. I had a client in Seattle, their son, they called me up, they're like, yeah, we paid him $30,000. I'm like, what? He doesn't pay tax on the first 14.6. I'm cool with that. And I go, 30,000? Yeah, he's a realtor in our brokerage at age 17. He had $30,000 in closings. Wonderful. Yeah. And so they get a tax write-off for that. And if your kid's under age 18, you don't even have to withhold FICA. No Social Security, no Medicare, no SUTA or FUTA, no W-2. You just called outside labor of the kids. The IRS, there's a line for this. The IRS is very well aware of this. It is not high risk. This is the way it works. And I've got books on this, podcasts on this, videos on this on YouTube all day long, people. Million view videos on how to pay your kids. Go learn about it. And if your accountant says this is high risk, holy crap, you've got the wrong accountant. I cannot emphasize that enough.
Yeah.
So
love it.
Paying kids.
Okay, got it. Under 18. Well, it goes for both. Is there anything additional?
Let me say this quickly, and some of you can grasp this quickly. You might have a little, accounting mindset. You're involved in your business finances. If your kids are under age 18, you have an S corporation. You set up a sister company that's a family management company, just a sole proprietorship, could be a DBA down at the bank. You transfer money from your S corp to the DBA. That's what pays the kids. If you pay your kids out of an S corporation, you either have to 1099 or W-2 them. An S corp is a company. It's not a person. So we need a sole proprietorship to pay your kids. If you don't have an S corporation, you're just going to pay them right out of your LLC. Call it outside labor. That's what it'll be called on the sole prop. If you have rental property, you pay them right out of your rental property LLC because they help with the rentals, cleaning, mowing lawns, whatever. If your kids are 18 or older, then you can pay them out at any company and they get a 1099. Once they're 18, you 1099 them. But Now they just have their own small business too. So they're going to report that, take write-offs for home office and auto and cell phone or whatever. And so now your kids are learning the American dream. They're involved in the business. They're getting paid as a subcontractor, 1099. If they act like an employee, look like an employee, they get a W-2. Two of my kids get a W-2. Two of my kids and a son-in-law, they get a 1099. So you can go different ways with depending on what role the kids play in the family business.
Love it. Awesome. This is good.
All right. Well, let's jump over to dining and travel.
We all do a lot of that.
Yes. And this is the perfect time of year. So I'm going to give you the method to do this. Dining, let's talk technically. Whenever you're having a business meeting and you have food, the food is a 50% write-off. You could go to an NFL game this Sunday and buy food galore in the box or whatever, and go and talk business with a client or one of your family members that's in the business. You could write off all your food, cut it in half because it's a 50% deduction on any food. But you can't write off the ticket to the game. That's entertainment. But I can write off all your dining when you have a business meeting and talk food. Number two, travel is 100% write-off. So let's say you get on a plane, you fly to a football game this weekend, and you stay in a hotel or an Airbnb, you rent a car, you've got Uber, you've got taxi, you take your client to the football game, can't write off the ticket, it's entertainment, but I can write off all the travel 100% and 50% of the dining to the game, at the game, after the game, and write off 2 days of travel to get to that meeting with that important client. Boom.
Now, why not on entertainment? That seems unfair. I mean, that's part of the purpose, right? You take an important prospective client to the Lakers game. I mean,
yeah. Well, it used to be a write-off for years. We love the entertainment deduction. With the passage of the Tax Cuts and Jobs Act, which President Trump passed in his first term, we got a lot of good things out of that Tax Cuts and Jobs Act. The 199A pass-through deduction, the bonus depreciation, writing off autos more strategically than ever since 1987. Incredible. But the IRS lobbied hard and said, we got to get rid of this entertainment deduction. It is abused at golf country clubs, boxes at all the games, concert tickets. All of that was a write-off. Deep sea fishing with your board of directors in Mexico, I wrote that one off. I mean, all of that was abused. IRS was like, So we had to give that up, kind of a bummer. But dining and travel is alive and well. Now, here's the strategy for you, Jeff, and so many of you listeners. Every one of your companies, and I talked about this a moment ago, should have a board of advisors, if it's an LLC, or a board of directors, if it's a corporation. Now, some of you are like, well, yeah, it's a pain to have a board meeting. My accountant or lawyer tells me to do it all the time. Yes, we do, because it's a great write-off. The perfect time for a board meeting is on a Thursday in November after a turkey dinner. We have a family board meeting every Christmas.
Yep.
You can fly in family members for the board meeting. You're going to have dining as a huge part of that. Hotel, airfare, Airbnbs, who knows? It is so common. And some of the most rewarding family experiences I've had is our family coming together to talk about our dreams, our finances, our small businesses, our rental properties, and we have a holiday in and around that. The business pays for the plane tickets. The business pays for the hotels and all that, the food.
And the turkey and the stuffing and all that stuff.
Absolutely.
Son
Absolutely.
of a gun.
My corporate card paid for the turkey that I picked up yesterday.
Damn it.
I mean, so, and here's the thing. When you have your annual board meeting, you're also making your corporation or LLC more asset protected. You're doing those annual minutes. You're writing down listed transaction strategies that need to be in there for an IRS audit. What are we going to buy? What are we going to sell? What were sales? What are this? What are that? We're hiring, we're firing. That's a board meeting. When clients come to we have a service that helps you do your business owner information filing. That's going to be on our list, BOI filing. But the board meeting, we have a 25-point checklist of things to talk about in your board meeting, so it's constructive. Again, totally expensive, but you should buckle up for it and just do it. We charge $200 to help give you the 25-point checklist, make sure you're good with the state, and file your BOI report with FinCEN and the federal government, which is now required, we'll come to that in a moment, before December 31st. So you're having your board meeting for better asset protection, you're taking a tax write-off, and you're creating a family experience, and it could be with your best friends. It could be with your mom and dad. It could be with your sister or brother. Whoever you're hanging out with in the holidays, they just got a new job. They're on your board.
Yeah. How often do you have to do these meetings per year?
Have to once a year. Could you hold a quarterly board meeting? Absolutely. My business partner and I do.
Yeah,
Talk
because
about
you can do it
hires
at Thanksgiving, at Christmas, at Easter, at July 4th, whatever.
boom, bada bang. Good stuff.
Okay, better question. What's too many meetings?
Well, if it's relative to the income of the business. If you're if you're a multi-million-dollar business, you're having meetings weekly. You've got travel expense budgets and dining budgets for all the executives. Those are meetings. But for a small business owner, having 2 or 3 board meetings a year, you're making 200 or 300 grand a year, or 6 figures, and you're building a business, you're buying rental property, you're building wealth, and you're going to have board meetings at all of your companies. You might have 2 or 3 LLCs with rentals. They need a board meeting. Yeah. Every LLC we set up, we ask who's on your board of advisors. Oh, sorry, people. You did it a LegalZoom where you did it so cheap ass. You got 1 sheet of paper in the drawer. Good luck in your lawsuit. Good luck in your audit. That's not an LLC or a corporation. You got to gear up and do it right. And that's an actual corporate book, minutes, bylaws, or operating agreement. And it's a tax write-off, for crying out loud. Yeah. Take advantage of it.
Yeah. Awesome. Love that one.
Okay. Which brings us to BOI, Business Owner Information Report. First ever, it was passed as a law, bipartisan, Republican and Democrats 3 years ago, to try to cut down on money laundering, child trafficking, human trafficking, drug dealers, people using and abusing LLCs and then disappearing, ripping people off. So now we have to self-report who is the manager and the owner with home address and a driver's license for every entity in this country.
This is 2 months ago, have done by the end of the year.
Exactly. And 2 months ago, the feds reported that only 10% of established entities in the United States had even reported yet.
I'm one of the one that keeps going to the website and not completing it. Guilty.
So, everybody, it is a $500 a day penalty and 2 years in jail if you do not get your BOI report done by December 31st.
Dude, what? I mean, 10%, that means I have to guess 50% are never going to do it. Are they really going to do that to 50% of the like LLCs that probably have just been doing nothing but collecting dust?
Here's the thing. Who are they really going after? Criminals. And you're damn straight. This is another stick that they can hit a criminal with when they hide behind an LLC and launder money or traffic fit children. Damn straight. But if you think that do you want to be the one that has to explain you're not a criminal and get the nasty letters in the mail and deal with this crap in Q1 and Q2 next year? Well, I'm innocent. I'm just going to report later. Fine, knock yourself out. You just created a lot of paperwork for yourself. So just buck up and deal with it. Yeah. For crying out loud. And we do the whole thing with your minutes for $200 called mainstreetbusiness.com. Mainstreetbusiness.com. We have, it's called Main Street Business Services. We'll get you set up, done, and just drop it. It's just online, done.
And what is the process for those? I think most are aware of this, but if you're not, and a lot of real estate agents may not be, because I don't think a lot of real estate agents necessarily look at themselves. I think they still look at themselves as employees, even though they're not.
Right.
How time consuming is it to fill out this filing or whatever you call it?
If you know what you're doing, you can do it in 15 minutes or less. But for the average realtor who is about relationships and communication and sales and cranking and moving 100 miles an hour, which I love, you can tell that's my energy. A typical agent is not in the minutia of their QuickBooks or their tax returns and what number needs to go on which line. So it can be daunting. And so they end up double checking everything, triple checking and Googling. Meanwhile, now you're into it an hour or so. You've started it several times and then have a question, so you stop. But what it is, it's called FinCEN, Financial Crimes Enforcement Agency. FinCEN will take you through the process on their website. You would need your driver's license, your home address, your company name, who are the owners and the managers. You input all that, done. We gather all that for you and do it and make sure you're good with the state, pay your state filing fee, and give you your paperwork for your minutes. So you're knocking out several birds with one stone. But you can go do it yourself, everybody. Do all of that yourself. But do the three things. Do your FinCEN, do your state, and do your minutes. And that's how you maintain a company.
Yeah. Got it. Is there a cost?
No, the feds don't charge you.
Got
It's
it.
free. Just got to
Got
do
it.
it. So no tax involved. It's pretty straightforward. Okay, next strategy, the auto deduction. Gotta
Yes.
love the auto deduction.
Yep.
Some of you, if you've done mileage in the past, which is the typical realtor investor move because they're on the road a lot, love the mileage deduction, but some of you may still have that second vehicle. Could be a truck, larger SUV, could be a car, luxury or not, lease or not. The auto deduction is the best it's been in 40 years. And you cannot underestimate the value of picking up a vehicle, if you need one, in December and taking the 60% bonus deduction and the 179. You could write off 25 grand of a vehicle quickly, and especially if it's a truck or SUV. There's a lot to be said there. You want to do your research. I've got, again, articles and podcasts and videos on it. But if you are in the market, I hate to see a client call up on December 31st, and I always get a call, hey, I'm down at the dealership. Should I buy an F-150? I'm like, do you need one? No, but I want a write-off. I'm like, oh my gosh, stop. So don't let the tax tail wag the dog. But the auto deduction's great. You don't even have to put any money down. You don't have to, you could do a trade-in and you get the write-off. You could buy it with a dollar down and get the write-off. And that goes for any equipment. Any of you need the computers, a new phone, printers, any equipment at all that might be helpful in your rental business, equipment over at Home Depot or Lowe's, go pick that up in December and take the write-off. Even if you put it on a credit card, you get the write-off and then pay off the bill in January 1st.
Yeah, I mean, nowadays your video equipment, tripods and stabilizers and drones and all that kind of stuff, which we're buying for our business.
Oh, totally. It's so important. Okay, next. Oh my gosh, and I don't know how many we're going to get through here. I'm going to throw down the solo 401k. This is one of the best strategies for a realtor or a real estate investor because they don't have a lot of employees. So you can go and create that solo 401k, defer money or do a Roth, and then also put in your company money as a match and even an after-tax contribution that could be Roth money. Now, I know that may have sounded like a mouthful, but the average American can put away $7,000 or $8,000 in an IRA. We can all do that. We can put it in an IRA or a Roth, and I challenge all of you to do that. We're going to come to another strategy here in a moment. But the solo 401k allows you to put away 5 times that, 6 times that. We can put away over $70,000 in a mega backdoor Roth IRA on the back of a solo 401k. So if you have an S corporation, you're a realtor, you're making some good money, we put that money in a solo 401k and you go buy a rental with the solo. You go buy crypto with the solo. You can invest that 401k in whatever you want. We've talked about it here before, Jeff, and I know you do all the time. Self-directing your retirement account is so powerful, and the real estate investors out there get it, and they're deploying their retirement accounts in real estate, and it's unbelievable.
Yeah.
If you want a solo, you have to set it up before year end. If you want to take an auto deduction, you have to buy the auto before year end. If you want to take a board meeting, dining, travel write-off, you've got to do it before year end. If you want to pay your kids, you actually have to pay them before year end. If you want to do the S Corp, you actually have to do it before year end. See, these are strategies I can't do in January, February, March, or April.
Yeah.
They're over.
And now you're just doing it for the following, or for the year you're in. You're doing it for 2025 at that point.
Yep. And this is going to air before the 30th, right? People are going
Yeah,
to
yeah, yeah. It'll probably air in the next week or two.
Okay, because December 1st is Sunday, right after Thanksgiving. It's going to play into another major strategy, and this is important on several levels. Healthcare planning. Oh my gosh, there's 3 strategies here. Let's hit HSA first. The health savings account is the best kept secret in America. I literally just did a podcast of 15 reasons why the HSA kicks ass. I mean, the health savings account is amazing. It's a front page tax deduction. AGI doesn't come into it. You never phase out. You can pull the money out immediately for any medical expense at any age. You can even reimburse yourself for medical expenses you spent 3 months ago, whatever, 3 years ago. The HSA is incredible. You can invest it in anything you want. My HSA owns a rental property. My HSA owns crypto, which has been flying. Whew. So health savings accounts are amazing, but you have to have a high deductible plan. And it's medical enrollment time right now. Health insurance enrollment is right now. And if you go to healthcare.gov and enroll in your insurance plan before December 1st, you can take the deduction for the entire year of 2024, even if you don't put the money in until April. Oh, by the way, on that solo 401k, you don't even have to put the money in until next year, but you have to set it up before year end. So the HSA is super powerful. I love it. It's a great strategy, and you got to deal with it right now during healthcare enrollment in the months of November and December.
What's the thing about the high deductible? Why do you have to take a high deductible plan?
Well, what the government said, and I think it's fair, is they're saying, hey, if you want to build a health savings account, then we want you to come out of pocket for some of your initial medical. So get a high deductible plan and come out of pocket for your that amount, and we'll let you sock money away. So some numbers are in 24, you can put away $4,150 if you're single, $8,300 if you're married or head of household. You have to have a high deductible plan, which is at least a $1,600 deductible if you're single, or $3,200 if you're a family. Now think of this. First, how many of you out there have health insurance you don't even use? Don't even use it. So holy crap, get a $1,600 deductible, put in $4,300 in your HSA, get a deduction, and if you have to pay out $1,600 because you have a bad medical situation, the money's sitting there in your HSA that you got a tax write-off for, and your tax savings pays for the deductible. It's a no-brainer. Yeah. And then if you stay healthy all year long, like your plan, that money grows tax-free, and you pass go and you get to put in another.
I didn't know you could use your HSA for other things. I thought it was just for medical expenses.
Well, the medical expenses is publication 502. Deductibles, co-pays, eyes, dental, anything medical at all at any age. Once you turn 65, you can pull it out for regular retirement. But the number one reason for bankruptcy, medical. The first reason people pull money out of an IRA or 401k, medical.
Yeah. So in other words, you probably should just leave it there.
Just leave it there, let it grow.
Well, but you said you're investing it in crypto.
Yes. So you build up that HSA because you're going to need it when you have a baby and you have got pregnant, baby birth or cancer or kidney dialysis, who knows what. The estimates are now that when you turn 60 years old, you're going to have over $400,000 in medical before you die. Wow. Where's that money come from? And so the HSA is super, super powerful. It is not use it or lose it. It's your money. It's portable. Your employer might put some money in. Great, you put some money in. You can put up to that dollar amount. So we could go on and on. I've got a podcast from just last week on the HSA people. Go check it out. Now, you have the flexible spending account. For any of you that have a use it or lose it plan at work, you have to use it before December 31st, or you lose it. So they might be giving you, this year, you can get up to $3,200 in a flexible spending account. And so if your employer, maybe your spouse has a day job while you're the realtor, do they have an FSA at work? Oh yeah, I've never used it. Turn in your damn receipts. Use it or lose it.
Yeah, for what? Like what kind of receipts can you turn in there?
Again, publication 502. The list goes on and on. Chiropractic, LASIK, massage therapy. It's huge list. Anything medical. Publication 502.
Got it.
Everybody's going to use it for something. Go down to LensCrafters, get a new set of glasses. Then there's the HRA, Health Reimbursement Arrangement. Let me give an example here. This was a realtor client of mine, such a great little family. It was probably 10, 15 years ago, but the story it stayed with me every year at this time of year. They had come in and said, hey, let's do some year-end tax planning. And I'm like, okay, bring your tax return. They had an S corporation. He was a great realtor. I think he was a broker and had a realtor working under him. They had a couple rental properties, middle of the road, 4 kids, just plugging along, right? Just working hard. I pull out their tax return and I see on their Schedule A, when you itemize, many of you know that, you try to write off your medical. They had like 25 grand in medical expenses, over and above insurance. I mean, we were already writing off your insurance premium. When you itemize, it's limited by your adjusted gross income. So you take 7.5% of your AGI, and anything above that, you get to write off your medical. But anything below that, you don't even get a write-off. So they were making 200 grand, he was cranking along as a realtor, right? That's very respectable. Well, you take 7.5% of that, that's 15 grand. So the first 15 grand, he couldn't even write off. So out of 25,000, he got to write off 10. So 15,000 was left on the table. And a lot of people don't even keep track of their medical anyway, because they know they can't write it off. So I go, do you have an HSA? No, we don't have a health savings account. I'm like, okay, well, let's do an HRA at least. Do you have a health reimbursement arrangement? And he's like, what's that? And they had just come to us from another accountant that was dragging their knuckles into this century, no planning and mindset at all. And I go, a health reimbursement arrangement is for small business owners where you can write off, as a solopreneur, all of your medical through your business as a health reimbursement arrangement. And you can still do the health savings account. So I go, we adopt the plan, it's like $400. We do it internally, you self-monitor, and you just reimburse yourself for medical. It's like a use it or lose it, but it's unlimited for you as a small business owner. It's called a 105 plan. I'm shocked you weren't doing this. And I go, how in the world do you have 25,000 in medical? And he goes, one of our kids has autism and 7 to 8 years old. He goes, this is a low year. They have special education, da-da-da. He goes, we'll spend 20 or 30 grand on out-of-pocket medical, just with his autism. And I was like, oh my gosh, you could have been writing this off all along. We're talking $200,000.
Yeah.
Both of them broke down in tears. And their accountant was like, sorry, I didn't know about it.
Ooh.
This is why you are the captain of your ship. Yeah. Like, well, my accountant knows everything. No, they don't. Do you know, I'll teach a class tomorrow with over 200 accountants in it, teaching them this. So they go out and call their clients. That's why you're doing this, Jeff. I'm so proud of you for having a conversation like this.
Always, man. Like I say, every year, maybe multiple times.
Yeah, it's crap. It's crazy. It's just crazy. All right. So our last strategy, we're at the top of the hour, aren't we? Okay.
Yep.
Okay, what did we do? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 strategies. Number 11, Roth chunking.
Oh.
We want to build our Roth IRAs as big as they can go because it's a tax-free ATM. So we can buy real estate in our Roth IRAs, crypto, notes, do short-term lending, long-term lending, first trust deeds, wholesales, all of that. When we have a Roth IRA, we can form an LLC and do real estate inside our LLC and be the manager of the LLC. It's awesome. Well, you got to get Roth money. So many of you have traditional IRAs or 401ks that you had from an old employer, or you're like, I don't even put money in my Roth because I didn't know I could do that. I don't want money in Wall Street. I want money in real estate. So Roth chunking is the concept that you're going to take any old traditional IRAs and convert them to a Roth IRA. Guess when the deadline is? December 31st. Mm-hmm. So if I want to do a backdoor Roth, if I want to do a solo 401k, I've got to convert to a Roth before December 31st. And that is part of that overall strategy of building wealth. And we've got clients with $10 million Roth IRAs in real estate. And every year they just put in another 5 grand, 10, 6 grand, 8 grand. But what you invested in can exponentially grow, however big. Yeah. So, well, there we go. There's 11.
There we go.
Isn't this fun?
I mean, you know what? It's actually no, but that's why we rely on people like you. I don't know if I've ever met a real estate agent that would say it's fun.
Well, hopefully it's fun now because you can make money easier than go out and get a closing. If I didn't, you know.
I was gonna say if you're listening to this today and you didn't learn something today, you're just already too smart. I defy anybody. And you know what? Many of us have been in the business for 25 years,
Yeah.
and we still are probably dealing with the same old accountant. So, Mark, what is the best way for people to get in touch with you and get you hired and take advantage of these costly, various things you can provide?
Yeah, these mistakes that so many people make. Well, here's the beauty of this. 3 years ago, I walked away from my personal accounting firm because we had a 5-year wait. People who had been on our waiting list to try to get in. I had old school accounts partners that didn't want to kind of push into the advisory space, and it was okay. They ran off into the sunset doing their own firms, and that's great. But then I created a network of accountants and I mentioned this at the beginning of the show, a tax advisory network, Main Street Tax Pros. And we almost have 800 accountants around the country on our network that all speak Mark Kohler. They've got to pass an 80 section test with me and come to weekly trainings to be on my network. And you can get to them and hire them yourself, interview them. They're West Coast, East Coast, big firm, little firm, black or white, young or old, male or female, anything you want. Get over to the network. It's at markjkohler.com. At the top, just click on services and it'll say Tax Pro Network. Go down to the network and just start searching. You can put in criteria, interview them, do a discovery call. I make no money on the relationship between you and your advisor. The Tax Pro Network is there for you. Now, if you want to get your BOI report done, get your S Corp done, come to our law firm in the Main Street Business Services, KQS Lawyers. Go to markjkohler.com and you can see all of that. Get hooked up, we're going to save you thousands of dollars. Next week, we have our Tax and Legal 360 event in Phoenix. You can attend virtually. It's sold out in person. And I think it's like $500. And we've got a flash sale on there right now for Black Friday and Cyber Monday. In 3 days, 25 classes on how to save taxes and build wealth. It'll blow your mind. And you can attend wherever and whenever you want. It's recorded, taxandlegal360.com. People would love it. It's just life-changing.
And if they want to go listen to some of these podcasts, where's the best place to do that?
Yeah. You just type in Mark J. Kohler on Google. You're going to see over 500,000 subscribers on YouTube, 100,000 on Instagram, my podcast, millions of downloads. So just type, and you can get to all of those on my website at markjkohler.com. And if my style bugs you, that's cool. I get it. Find an accountant that you do follow, because this is the number one cost in your lives, people. And you got to captain your ship. If you think my accountant's going to take care of it, they are not.
Yeah.
They're not.
Yeah.
It's got to be collaborative. You've got to be on the same side of the table with them and driving a meeting, saying, please, can we meet? Because if you're not meeting with your accountant regularly, you're not having the conversation we had today.
Yeah. Yeah. And I don't think a lot of people are doing that. So so probably the best place to go, really, just from an all-encompassing is markjkohler.com, right?
Yeah, just start right there. You can get to everywhere. So
I love it, dude. You are always a pleasure to have a conversation with. We learn something new every single year. We will keep doing this as often as you are generous to join us. Appreciate you, man, and I'm sure this won't be the last time we talk in the next 12 months.
Oh, thank you so much, Jeff. I appreciate it. And we'll see you again in the spring. Call it before April 15th isn't bad. I'm just saying it's more powerful in December. So
I think this is fantastic. Thank you, man. I appreciate you.
Thank you. We'll see you around.